Hey there, and welcome to This Explainer. Okay, so buying your very first home is easily one of the most exciting milestones in life, right? You're finally picturing your own space, your very own front door. But let's be honest, the second you start looking into the financial side of things, that excitement can kind of quickly turn into sheer anxiety. The financial jargon alone can feel like an absolute maze. You're suddenly hit with acronyms like PMI, FHA, and these endless debates about interest rates. If the math of home buying feels super overwhelming right now, take a deep breath. You are in the right place. Today, we're breaking down one of the absolutely most crucial parts of the whole shebang, the down payment. We're going to demystify the numbers and give you the knowledge you need to actually make this dream a reality.
Right off the bat, let's address the absolute biggest source of anxiety for most first-time buyers. The big question we hear all the time: do you really need to put 20% down to buy a house? I mean, you've probably had well-meaning friends or relatives tell you that you literally must have a 20% down payment saved up before you even think about calling a real estate agent. It's a huge number, and for a lot of people, it completely stops their home buying journey before it even starts. Well, we are going to completely demystify this idea today and reassure you that the modern landscape of buying a home actually looks very, very different than you might think. Okay, let's dive right into this. Here's our roadmap for today. We'll define what a down payment is, tackle that 20% myth, explore your loan options, break down the monthly costs and PMI, and wrap up with some actionable tips to start saving. Section 1. What is a down payment? Getting your skin in the game. So at its absolute simplest, a down payment is the upfront sum of money you pay straight out of your own pocket when you purchase a home. Because, when you buy a house, you typically aren't paying the whole price in cash all at once. Instead, you put up a portion of the cost yourself, and your lender steps in to provide the rest as a mortgage loan. Now, you might be wondering, why does the lender actually make you do this? Well, it represents a real commitment from you. It's your initial ownership stake in the property, which is also known as equity. When you have thousands of your own hard-earned dollars invested into a property right from day one, lenders know you're way more likely to keep up with those monthly payments. Plus, this equity significantly lowers your risk of going underwater, which is a pretty scary situation where you basically end up owing more on the house than it's actually worth. Let's make this math completely concrete. Imagine you find a beautiful home priced at $300,000. If you decide to put 10% down, you're paying $30,000 up front at the closing table. Your mortgage lender then covers the remaining $270,000, which you'll pay back over time. That $30,000, that is your immediate equity. It means you actually own 10% of your home's value on the very first day you get those keys. How cool is that? Moving on to Section 2. The 20% myth, breaking down the gold standard. It is time to break down what used to be the absolute gold standard of real estate. For decades, 20% was the magic number. But think about it. On a $400,000 home, a 20% down payment is a whopping $80,000 in cash. For many people, especially first-time buyers who are already juggling rent and everyday expenses, saving an $80,000 lump sum can take literally years. And frankly, it can feel impossible. But here is a much-needed reality check. You do not necessarily need 20%. While the old myth screams that you must have it, research actually shows the typical first-time buyer in 2025 puts down closer to 10%. You absolutely don't have to wait a decade to buy a home.
Section 3. Exploring loan options. Finding the right fit for you.
The amount you actually need to save depends heavily on the type of loan you end up choosing, and you have so many options to fit your specific situation. First up, conventional loans. These are your standard loans not backed by the government, and they often allow as little as 3% down for first-time buyers. Then we have FHA loans, which are backed by the Federal Housing Administration. These only require 3.5% down. Now, I want to bust a quick myth right here. Some folks think FHA loans are only for buyers with bad credit. Absolutely not true. While they are a bit more forgiving with credit scores, plenty of people with totally excellent credit choose FHA loans simply to take advantage of that low down payment. Next, VA loans. If you're a veteran or an active duty service member, you might qualify for a 0% down payment, which is just an incredible benefit. And finally, USDA loans. These are designed for homes in rural and some suburban areas, and they also offer a 0% down option for eligible buyers. So 3%, 3.5%, or even 20% is for sure not your only option.
Section 4. Monthly costs and PMI, the math behind the mortgage. Now that we know each options, let's look at how the size of that down payment impacts your wallet every single month. And this brilliantly illustrates the trade-off. Basically, the more money you put down up front, the lower your monthly payment is going to be. For example, on a $375,000 home with a 6.5% interest rate, a 5% down payment means your monthly principal and interest might sit right around $2,299. But if you manage to put 20% down, that exact same monthly payment drops to $1,896. That is a savings of about $400 every single month. Over the life of a 30-year loan, putting more money down at the start drastically reduces your overall debt and the total interest you'll end up paying. Plus, it can often help you secure a slightly better interest rate. But there is a catch we definitely need to talk about if you put down less than 20%, and that is PMI. PMI stands for Private Mortgage Insurance. This is a monthly fee that protects the lender, not you, the lender, in case you stop making your payments. If you use a conventional loan and put down anything less than 20%, your lender is usually going to require you to pay this monthly premium. And honestly, it's not pocket change. On that same $375,000 home we just looked at, PMI could easily add over $300 a month to your mortgage bill.
Now, a huge myth out there is that PMI is just a total waste of money. But here is a massive secret to kind of reframe your thinking. PMI isn't permanent on conventional loans. Once you've paid off enough of your loan, or your home goes up in value enough to reach 20 to 22% equity, that insurance can typically be removed entirely. And that instantly lowers your monthly costs. Think of PMI not as a punishment, but really as a helpful tool. It's a stepping stone that allows you to buy a home now, start building equity now, and lock in a home price now, instead of spending the next 10 years stuck in an apartment trying to save up a massive 20% lump sum.
Section 5. Tips to start saving. Building your action plan.
Okay, let's pivot from the math and build your practical action plan. Here are 4 actionable steps you can literally take today. Step 1, set a clear goal. Get online, use a basic mortgage calculator, and see exactly what 3% or 10% looks like for your specific target home price in your area. Step 2, automate your savings. Set up a direct transfer from your paycheck straight into a dedicated house fund savings account, so you don't even see the money. Step 3, and this is highly critical, do not drain your entire bank account. It is a massive rookie mistake to use every single penny you have for the down payment. You absolutely must keep a separate emergency fund for unexpected repairs or moving costs once you actually buy the house. And step 4, look for down payment assistance, or DPA programs. There are thousands of these nationwide offered by states, cities, and nonprofits. They provide grants or low-interest loans to help cover these exact upfront costs. So the crucial point is this. Your down payment strategy is a deeply personal choice, but it's one you now have the tools to make. Let's quickly summarize our key takeaways. First, your down payment is your initial investment. It gives you immediate ownership and equity in your new home. Second, you have so many options. You do not have to wait for 20% down. With conventional FHA, VA, and USDA loans, you can start at 3% or even 0. And third, if you can put more down, a larger down payment will mathematically lower your monthly costs and help you avoid extra insurance fees like PMI. Understanding all of these concepts is really the very first step toward walking through your own front door. Whether you decide to save aggressively for a large down payment to lower your monthly costs, or you want to take advantage of a low down payment program to get into a house right now, home ownership is attainable. So I'll leave you with this question. What step will you take today to start your home buying journey? Maybe it's opening that dedicated savings account, or maybe it's researching down payment assistance programs in your county. Keep learning, keep exploring your options, and you'll be holding those house keys before you know it. Thanks for joining me on this explainer, and hey, happy house hunting.